Most traders see a trend starting to reverse and immediately jump in at the worst possible moment, right at the highs or lows. They get stopped out by the slightest retracement, or worse, they watch their account balance disappear when the trend fails completely. But what if I told you there's a specific moment, a perfect entry point, that shows up in almost every single trend reversal? The pattern I'm talking about here is the first pullback, and in this video, I'll walk you through exactly how you can use it to slash your losses while dramatically increasing your profit potential on every single trade you take. This isn't theory. This is a battle-tested strategy that works across every market, every time frame, and most importantly, it works consistently. So what exactly is the first pullback? Think about it this way. Imagine you're watching price action unfold in a downtrend, and suddenly you notice the momentum shifting. The bears are losing control, and the bulls are starting to take charge. Now here's what separates amateur traders from the professionals. Amateurs think price is going to rocket straight up in a perfect V-shaped reversal. But that's not how markets actually move. What really happens is this. Price starts to reverse, gains some momentum upward, then takes a brief pause and pulls back slightly before continuing its climb. This initial retracement after the reversal begins is what we call the first pullback, and it's one of the most reliable patterns you'll ever find on your charts. Let me show you exactly what I'm talking about. Take a look at this cryptocurrency chart where price was grinding lower in a clear downtrend. Notice how when the reversal finally came, price didn't just shoot straight up. Instead, it made this beautiful initial push higher, then gave us this textbook pullback before resuming the upward journey. This is the first pullback in action. Here's another perfect example from the forex markets. We had price trending upward initially, then the bears took control and started pushing price down. But watch what happens next. Instead of a straight line drop, price makes this initial move lower, then pulls back slightly before continuing the downward trend. Same pattern, just in the opposite direction. And here's one more from the stock market. Price was falling, then suddenly the buyers stepped in and started pushing higher. But again, notice this crucial detail. After the initial push up, price came back down in a small pullback before the real move began. This pattern is literally everywhere once you know what to look for. The secret behind this strategy comes down to one critical factor that most traders never consider: the risk to reward ratio. Let me break this down for you with a real-world example. Picture this scenario. You've spotted a setup where price was hammering lower in a downtrend. Then suddenly, massive buying pressure comes in and starts pushing price higher. As a trend trader, you recognize that momentum is shifting and you're thinking about going long. But here's where most traders make their biggest mistake. They buy immediately at the highs of that initial move. Why is this such a dangerous approach? Because there's a significant chance that price could pull back from those highs, or even worse, the entire uptrend could fail completely. If you enter at the peak with a tight stop loss, that natural pullback alone will knock you out of the trade. And if you try to accommodate the pullback with a wider stop loss, you're setting yourself up for massive losses if the trend reversal fails altogether. This is exactly why waiting for the first pullback is such a game-changing approach. When you enter during the pullback, you're getting into the trade at a much more favorable price point. This means your stop loss can be significantly tighter because if price continues dropping after the pullback, that's actually telling you the uptrend was invalid anyway. So your tight stop loss keeps your losses absolutely minimal. But here's the beautiful part. If the trend holds and price pushes higher from your pullback entry, you're positioned to make substantially bigger profits since you entered at a lower price. It's the perfect win-win scenario: smaller losses on failed trades and much higher gains on successful ones. Now let me walk you through exactly how to trade this strategy step by step, starting with the most crucial element that determines whether this entire approach will work for you. The foundation of trading the first pullback successfully is knowing how to properly identify a trend reversal. This part is absolutely critical because if you mess this up, nothing else matters. Here's how the professionals do it. One of the very first concepts traders learn is how to identify uptrends and downtrends. If price is making higher highs and higher lows, you've got an uptrend. If it's making lower highs and lower lows, you've got a downtrend. Sounds simple enough, right? But what if I told you that you're actually getting this completely wrong? Let me show you what I mean with this example. Imagine you're looking at a chart that's clearly forming higher highs and higher lows, showing a textbook uptrend. But then something happens. Price starts heading down and breaks through a previous low. Here's where I see countless traders make a costly mistake. When they see that low get broken, they immediately assume the trend has reversed, and now they're looking at a downtrend. But what if I told you that this chart is fundamentally bullish? The reason is that the low that got broken wasn't actually a valid low in the first place. For a low to be considered valid, price needs to break the previous high after forming that low. In our example, price never actually broke the previous high after making that low, which means the valid low is actually much further back. So price can do whatever it wants in this area, but as long as it stays above the true valid low, we're still in an uptrend. Let me take this concept even further. If price instead moves up and breaks through the previous high, this establishes a new high in the trend structure. When that happens, the valid low shifts to the most recent low that occurred before that breakout. For the trend to actually reverse, price would now need to break this new valid low. Here's how this looks on a real chart. Notice how price is forming these higher highs and higher lows, and we can identify that the valid low is this specific point because price broke the previous high immediately afterward. Later in the move, price moves down and breaks through this valid low. This break confirms the reversal because price actually closed below the valid low. This is crucial. You need to wait for a candle to actually close below the valid low for it to count as a legitimate reversal. A simple wick or temporary break doesn't cut it. Once you've mastered identifying valid reversals, we can move to the next phase, entering at the first pullback. The key here is figuring out where that pullback is most likely to form, because pullbacks can happen anywhere on the chart, and identifying the right area is essential for timing your entry perfectly. From years of studying these patterns, I've discovered that first pullbacks tend to form and bounce from very specific areas, and the most reliable of these is the Fibonacci retracement zone. For those who haven't used this tool before, it's an automatic calculation that highlights key levels based on Fibonacci numbers. The tool generates multiple horizontal lines, and price has the potential to bounce off any of these levels. However, there's one specific level that stands out above all the others, the 61.8% level, also known as the golden zone. This is where price most commonly pulls back to, making it the most reliable area to watch for your entry. Here's exactly how I implement this approach. First, when I've identified a potential first pullback scenario like this one, I'll draw the Fibonacci retracement tool by dragging it from the low of the move to the high. Then, at the 61.8% Fibonacci level, I place a buy order with a stop loss set slightly below my entry point. For the take profit, I have two main approaches. I either aim for the previous high, or I target an even higher level, because these setups often have the potential to run significantly beyond the initial reversal point. Once everything is set up, I simply let the market do its thing. Watch what happens in this example. Price barely wicks into our entry level before bouncing off and delivering a profitable trade. This is the power of the 61.8% retracement level in action. Another incredibly effective way to identify where the first pullback might occur is using supply and demand levels. These are areas where significant buyers or sellers have placed large trades, creating zones of interest that price tends to respect when it returns to them. The basic concept is that if price retraces toward a supply or demand level, there's a high probability it will bounce from that area, similar to how traditional support and resistance levels work. If we can identify these zones on our charts, we can potentially predict exactly where the first pullback will occur. The easiest method for identifying supply and demand zones is looking at the area immediately before a sharp price point. If price makes an explosive move upward, the area right before that surge is called a demand level. Similarly, if price makes a sharp move downward, the area immediately before that drop is called a supply level. Going back to our original example, you can spot this impulsive downward move that helps us mark the supply zone. To create this zone, I highlight the last candle before the impulsive move occurred and use a rectangle tool to draw the zone from the candle's high to its low. This marked area becomes our supply zone. Once you've identified a supply zone, you can place a sell order at the bottom of the supply level, set your stop loss slightly above the supply zone, and target a take profit level at 2 times the size of your stop loss. Alternatively, you can aim for the previous lows as your profit target. Let me clarify something important about this strategy. You're not entering the market at the current price. Instead, you're setting a limit order at your desired entry price along with your stop loss and take profit levels. Once everything is configured, you simply leave it alone and let price do its work. The trade only activates if the first pullback actually happens and price hits your entry point. Like in this example where price comes back, hits our sell entry and bounces from the supply level, giving us a beautiful profit. Let me show you another example that introduces an additional tool for situations where trend identification becomes tricky or simply when you are too lazy to do it manually. But first, I want to take a moment to thank our amazing community. We went through all the comments under one of our last videos and we selected the most useful one. To show our appreciation, we are gifting that viewer 1 free month of Flux charts. Please reach out to our email to claim your free subscription. Now, if you haven't heard about Flux charts yet, this is the platform I personally use every single day for my trades, and honestly, it completely changed how I trade. Flux charts has this insane feature where you can run screeners on up to 15 tickers and timeframes at once. Yes, 15. So instead of flipping through chart after chart, the screener just tells me exactly where my setups are happening. It saves me so much time. They also have backtesting tools that let you build totally custom strategies and test them against years of market data in seconds, so you know if a strategy actually works before risking a single dollar. And here's the best part. 90% of their indicators are completely free. That's wild because most platforms don't even give you one good indicator for free. On top of that, they host daily live trading classes, teaching not just how to use their tools, but how to build strategies, manage risk, and sharpen your trading mindset. And here's the best part. This month, there's an even bigger discount than usual. Check the description to discover the special offer, and I promise you're going to love it. Alright, let's get back to the video. While there are countless indicators available for trend identification, I prefer the enhanced wave trend because it's straightforward and incredibly reliable. Let's apply this indicator to our setup. First, you need to add the enhanced wave trend oscillator to your chart. Click on Indicators, type in Enhanced Wave Trend, and select the one called Enhanced Wave Trend Oscillator created by this guy. This indicator is an advanced version of the original wave trend oscillator, specifically designed to identify overbought and oversold conditions in the market. Let me break down the key features and functionalities you need to understand. The main component is the wave trend oscillator ribbon. The upper horizontal level represents the overbought zone, while the bottom horizontal level represents the oversold zone. Then we have these colored dots that appear at the overbought and oversold levels. These indicate instances where the market has reached extreme conditions. Whenever the wave trend moves into the upper horizontal level, a purple circle appears, indicating that the market might be overbought and due for a reversal lower. Conversely, whenever the wave trend drops into the lower horizontal level, a blue circle appears, signaling an oversold market that could be ready to bounce higher. Now, let's access the settings of this indicator so we can modify it to perfectly suit our strategy. On the Style tab, we want to disable the histogram as well as the midline. After making these changes, click OK. With the settings optimized, using this indicator becomes remarkably simple. We're going to use it to identify potential reversal points in the market based on these oversold and overbought conditions. When the market reaches an oversold state, indicated by the wave trend oscillator moving into the oversold level and printing a blue circle, this gives us a signal to consider a long position. For short positions, we do the opposite. We wait for the wave trend oscillator to move into the upper horizontal level and print a purple circle, indicating a potentially overbought market with a higher probability of reversing to the downside. Once the enhanced wave trend is applied to our chart, we can use it to confirm whether this upward move represents a valid reversal. In this particular setup, we can see that it shows an oversold condition with a blue circle appearing at this specific point. That's our confirmation signal that the reversal is legitimate and that we're now looking at an uptrend. Now we can proceed to the next step, which is entering at the first pullback using either Fibonacci retracements or demand levels, exactly as we discussed earlier. In this example, price pulls back beautifully, triggers our buy entry, and then continues upward to hit our take profit target. Sometimes, price may not even retest your entry level and just continues running in your favor. You will miss some trade opportunities using this approach, but missing a trade is completely different from losing one. Personally, I would much rather stick to high win rate setups and enter at optimal prices, rather than chase every move and end up with poor risk-to-reward ratios. This disciplined approach is what separates consistently profitable traders from those who struggle to maintain their accounts over time. The first pullback strategy isn't just another trading technique. It's a complete mindset shift that focuses on patience, precision, and proper risk management. When you master this approach, you'll find that your trading transforms from emotional guesswork into a systematic, profitable business. Thanks for watching, and see you guys next time.